Benjamin Graham wasn't just an investor. He was a philosopher of money. He believed that wealth is built not by predicting the future, but by controlling yourself in the present. According to Graham, there are two kinds of investors. The emotional investor, who reacts, panics, chases, and hopes. The intelligent investor, who thinks, observes, and acts with discipline. This isn't a book about getting rich fast. It's a manual on how to never be poor again. How to build wealth slow, steady, and unshakable, no matter what the market is doing. So let's begin the journey. Chapter 1. Meet Mr. Market, the character that lives in your mind. Imagine you own a business. Every morning, your business partner, Mr. Market, knocks on your door and offers to either buy your share or sell you his. Some days, he's ecstatic. He offers you ridiculously high prices. Other days, he's depressed. He panics and offers you very low prices. He never thinks clearly. He's either euphoric or terrified. But here's the key. You don't have to respond. You don't have to buy. You don't have to sell. You simply listen and decide whether the price makes sense. This character, Mr. Market, is not outside you. He's your emotions. When the market rises, he whispers, "Everyone's getting rich. Buy now before you miss out." When the market falls, he screams, "It's over. Sell everything." The intelligent investor understands Mr. Market is irrational and uses his mood swings to their advantage. Mini reflection. Remember the last time you heard about a stock going up and you felt the urge to buy? That wasn't logic. That was Mr. Market knocking. Chapter 2. The difference between investing and speculation. Graham makes one thing very clear. If you don't know the difference between investing and speculating, you're gambling. Speculators chase quick profits. Investors seek long-term value. Speculators ask, "Will this go up next week?" Investors ask, "Is this worth owning for the next decade?" Most people call themselves investors, but behave like speculators. They buy stocks because they saw it on social media. They buy because a friend recommended it. They buy because it's trending. That's speculation. And speculation is just a sophisticated form of panic waiting to happen. An intelligent investor studies businesses, not tickers. They invest in companies, not hype. Chapter 3. The Margin of Safety, the Holy Grail of Investing. If there is one principle that makes someone unbeatable in the stock market, it's this. Always buy with a margin of safety. Think of it like this. If a bridge is meant to support 10,000 kilograms, engineers will design it to hold 30,000 kilograms. Why? Because life is uncertain. Same with investing. If you think a company is worth $100 per share, the intelligent investor buys at $70 or $60, not $110. Why? Because life and markets are unpredictable. A margin of safety protects you even if your predictions are wrong. It's not about being perfect. It's about being prepared. That's why intelligent investors rarely suffer catastrophic losses, while emotional investors blow up during every crash. Chapter 4. The two kinds of intelligent investors. This chapter is essential because Graham says you must choose your path. 1. The defensive investor, the safe builder. This investor wants minimal effort, minimal time, minimal risk. Strategies: diversify. Buy strong, stable companies. Prefer index funds. Avoid speculation entirely. A defensive investor doesn't chase big wins. They avoid big losses and win in the long run. 2. The enterprising investor, the skilled player. This investor studies, researches, looks for undervalued companies, takes advantage of market mistakes. This is the slow, patient hunt for value. The enterprising investor is not a gambler. They're a detective. They look for good businesses temporarily selling for cheap. Both paths lead to wealth, but mixing them leads to disaster. Choose one and stay committed. Chapter 5. Stocks versus Bonds, the Balance of Power. Graham recommends a simple rule. Your portfolio should be a combination of stocks, bonds, and you adjust based on market conditions. If the market is overheated, hold more bonds. If the market crashes, buy more stocks. Emotion says, market is crashing, run away. Intelligence says, market is crashing, everything is cheaper. This simple rule alone can change a lifetime. Chapter 6. How to actually pick good investments. Graham's checklist for a strong, safe company. Stable financial history. Consistent earnings. Moderate debt. Strong reputation. A reasonable, not overpriced valuation. Notice something? It doesn't include hype, popularity, trending news, social media predictions. This stock will explode. The intelligent investor acts based on facts, not forecasts. Chapter 7. Why the biggest enemy is your own brain. This is the heart of the book, and what truly separates losers from winners in the market. Your brain is wired to sabotage you in investing. When everyone buys, you feel excited. When everyone sells, you feel scared. When you see a stock rising, fear of missing out. When you see a stock falling, fear of losing everything. Your emotions want safety, but real safety comes from discipline, not reaction. The intelligent investor doesn't ask, how do I beat the market? They ask, how do I beat my own fear? Chapter 8. The Power of Patience. Buffett says, the stock market is a device for transferring money from the impatient to the patient. The intelligent investor understands that wealth grows like a tree, slowly, silently, naturally. You don't check your height every hour. You don't dig up seeds to see if they're growing. You plant, you water, you wait. Investing is the same. Chapter 9. The most underrated skill, staying calm during crashes. Market crashes terrify most people, but intelligent investors see crashes as clearance sales. Imagine your favorite product suddenly 40% off. You'd celebrate. But when stocks do that, people panic. Why? Emotion. Graham teaches, the intelligent investor is a realist who sells to optimists and buys from pessimists. When others panic, you stay grounded. That alone makes you unbeatable. Chapter 10. What the intelligent investor really means. Being an intelligent investor doesn't mean being a genius. It means controlling your emotions, thinking independently, being disciplined, being patient, checking ignoring crowds, focusing on value, not noise. It's not flashy. It's not dramatic. It's not about timing the market. It's about temperament, your mindset, your inner stability. That's what makes fortunes. The stock market doesn't reward the smartest person in the room. It rewards the calmest. You don't need predictions. You don't need shortcuts. You don't need to chase hype. You need patience. You need discipline. You need consistency. Because once you master yourself, you've already mastered the market. This is the Bookkeeper, where we don't just break down books, we break down mindsets. If this changed how you think about wealth, stay with us. There's more wisdom coming.